Coming up on the SBS On The Money podcast, GDP misses the mark. The Australian share market only points away from a record, but the Commonwealth Bank reaches $300 billion. That's all next. Hi everyone, it is Wednesday, the 4th of June 2025, where the Australian share market edged closer to a record high. The S&P ASX 200 up 0.9%. That is just 14 points away from the February high. We'll have the details with Luke Laretive from Seneca Financial Solutions in a few moments. But first to the economy, where GDP expanded by less than expected 0.2% on the quarter to be up 1.3% on the year. To tell us what it means for the economy and interest rates, I spoke with Stephen Wu, a senior economist at the Commonwealth Bank. Stephen, so the GDP numbers out today, what does it say about the economy?
Yeah, so today we received the March quarter national accounts, which includes the GDP numbers for the first 3 months of this year. That showed the economy grew by just 0.2% in the quarter, and the annual rate stayed steady at about 1.3%. So look, it does suggest it was a bit of a soft start to 2025. We did see some strength in the back end of last year that looks to have dissipated over the first 3 months of 2025. That being said, I think there were some one-off or temporary factors at play. We did see the economy affected by things like extreme weather events, natural disasters. That did play a role in weighing on overall growth outcomes. But still, I think the trend is quite soft, although we do expect to see a bit of a rebound through the rest of this year.
So you mentioned those factors. Overall, it was softer than expected. How much did it have to do with those domestic factors like household spending and those extreme weather events? And how much external, specifically tariffs?
Yeah, so we did see weakness, particularly in household consumption. So that was quite strong at the back end of last year. There's a sense there that promotional activity really drove or brought forward some spending by households into the last quarter of 2024. That is a little bit in the first 3 months of this year. So that was some softness there. And if you actually abstract from the impact from the unwind of energy rebates, it was only about a 0.2% increase in household consumption. In other words, it was falling in per capita terms. Now, on the tariffs, it's an interesting question. But these figures are only for the March quarter, so it predates the so-called Liberation Day tariffs from April 2nd. That being said, it was pretty interesting to note that we did see actually quite strong demand for our beef exports from the United States. So that tells us that there is still some sort of ongoing positives from our trading relationships as it kind of plays out over this year. I'd also note as well that the tariff rate that's applied to Australia is 10%. It's the baseline rate. So from that perspective, it means that we're not any more disadvantaged than other trading partners with the United States, and that could actually support our overall growth outcomes this year.
Per capita GDP turned negative, while the household savings ratio also rose a bit. What does this say about the consumer? And then what about the business sector too?
It really tells us that the consumer is still very cautious right now. So yes, we did see some strength in the back end of last year. That was a reflection of just discounting and promotional activity, bringing forward some spending. What we're seeing in the first 3 months of this year is just a bit more softness from that pull forward. So we know that spending in per capita terms has gone backwards again. GDP per capita terms also gone backwards in the quarter. But what matters for businesses is actually aggregate outcomes and aggregate spending. So it matters less so, what each person is spending in per person terms, but more so what the total economy is spending. So that still remains a little bit better than what the per capita numbers would suggest. But it is, pointing to some signs that business conditions and profitability are easing a little bit. And certainly, it will also be weighed down when we get the next quarter number by uncertainty around the global environment as well.
So speaking about that next quarter number, as you alluded to, these numbers are backward looking, right? So is the economy now likely to performing better or worse than the numbers we saw today? And taking into consideration, we also heard from the OECD today saying that it expects Australia's economy to be at 1.8% next year. So where are we at the moment, especially given especially with tariffs in play too?
Yeah, so we did see softness in today's numbers, but we still do expect to see a fairly gradual rebound in momentum over the rest of this year. Now, key to that is an assessment that the household sector will actually continue to grow and actually grow a little bit quicker than what we've seen so far. And driving that's going to be a further increase in real household disposable income. So we know that we saw, quite solid growth in incomes as we've had low unemployment still, and also an increase in wages growth. We also know some of the detractors from disposable income are also fading. So inflation's coming down. We also got lower income taxes because of the statutory tax cuts from July last year. And also the RBA is now sort of underway with their easing cycle. They'll put more money back into households' pockets. So that should support overall household spending going forward and also the economy. So we are expecting to see a bit of a gradual uptick in GDP growth outcomes this year, with the caveat, of course, that we are still watching the global situation very closely. If things do deteriorate, we could well see some impact on Australia.
So finally, given that lower interest rates feed into that increase in growth, where are you expecting the Reserve Bank to lower interest rates to?
Yeah, so we haven't shifted our thinking on the profile for further rate cuts from the RBA. It's still very clear that the RBA will need to and will deliver further rate cuts. I think today's data at the margin does shift the balance of probabilities towards earlier rate cuts rather than later rate cuts. But we still maintain that August is the most likely meeting for the next 25 basis point rate cut, followed by another one in September. There is a case to be made that we should see rate cuts being brought forward to maybe, say, July. But we think the RBA still remains a little bit cautious in how it wants to proceed with further rate cuts from here. They will want to see more data, and they will, of course, get the all-important quarterly CPI numbers ahead of the August meeting. That being said, there's every chance still that if the monthly CPI numbers that we get later this month or the labour market data is a bit softer, we could well see the RBA decide to deliver earlier rate relief.
That is Stephen Wu there from Now Market Day on the SBS On The Money podcast. Good day for the Australian share market, reaching just 14 points away from a record high close on the S&P ASX 200. It ended the day 0.9% stronger to 8,541. A milestone also reached from the Commonwealth Bank. Shares closing above $180 with a market cap of more than $300 billion. For more on the day's market action, I spoke with Luke Laretive, CEO of Seneca Financial Solutions.
Yeah, it was a strong lead from the US overnight, Ricardo. S&P 500 was up about 0.58% at the close. However, it was really a perfect storm for the ASX today, with the two main sort of parts of our market getting positive news. So you've got higher commodity prices and lower interest rate expectations. So that's what's driven the market up about 0.71% to 3 o'clock today. The oil price was up 1% overnight. That's pushed the energy sector up 1.6% today. That's the best performing part of the market. While we saw iron ore futures jump 1% this morning as well. And that's been positive for the likes of, Fortescue, BHP, as you probably expect. In the banks, and that's sort of the other major part of our index, we saw weaker than expected Q1 GDP growth. And that came in at 0.2%, which was, sort of now down to a kind of anemic 1.3% per annum. So that's opened the door for a 50 basis point rate cut in July. And as we know, that's supportive for loan volumes and asset values. And as a result, the banks are up 0.93% today.
Now, speaking of the market doing well, we're now only just a few points from a record on the ASX 200. Does the way the market rallied after the big fall triggered by Donald Trump's reciprocal tariffs just a couple of months ago surprise you?
Not really, Ricardo. I think, once it was clear to markets that Trump's sort of initial stance and rhetoric would kind of be a worst case scenario, the markets began to sort of price a likely future, a future where, incremental news flow is increasingly positive, and with lower than stated tariffs and these sort of softened deals, I suppose, I think it was a real clear buy the dip opportunity. But going forward, I mean, the market's sort of enjoying this Trump predictable cycle of sort of escalation and then relief. That's seen risk premiums decline, shares rally. So nothing too surprising. I think the media is probably more hanging on Trump's every word than the share market is these days.
Okay. You mentioned the banks earlier today. The Commonwealth Bank now the first to reach $300 billion market cap. It's more than $100 billion more than BHP, which is second right in Australia. What's your take on the company and the rest of the banking sector as we move through this uncertain economic environment and lower interest rates?
Yeah, I think lower rates are positive for the banking sector, and but they're perhaps not the best way for investors to play those falling rates. CBA is the most expensive bank in the world. It trades on 29 times earnings, to a 30% premium to its developed market peers around the world, and it's almost a 40% premium to the other Australian three major banks. And this is despite the fact that it's generating lower than peer group return on equity. And you've got peers like in Europe and the US who are trading on 6 times, 14 times earnings, 11 times earnings, all kind of generating better returns for their investors at the moment. So, given these dynamics, we kind of think that, the best way to maybe gain exposure to these falling rates here in Australia is outside those big four banks. A large position in our small companies fund and our large cap strategy actually as well is Australian Finance Group, AFG. Its shares are up about 58% since April on the back of investors starting to realise the leverage it's got to rising loan volumes and lower wholesale funding costs. But the shares are still relatively inexpensive at only sort of 15 times earnings and offering a 6.5% fully franked dividend yield. So while the banks are a good way to play falling rates, we think there's better exposures on the ASX.
And finally, what are you telling your clients right now, and where do you see the opportunities for investors?
It's really a range of sort of stock-specific ideas at the moment that are driving out performance for our clients. We've had, technology companies like Catapult and Megaport do quite well for us, but the mining names are also doing well, Antipra Minerals and Ramelius. As I mentioned, we do see value in these non-bank financials, like AFG, but also maybe the likes of Challenger or the Square Payments provider Block, as well as a few sort of select healthcare names such as, Neuron Pharmaceuticals or Monash IVF. We think the biggest risk for investors at this point in the cycle is the opportunity cost of holding cash and cash in term deposits. By the time the term deposit rates are kind of unattractive on face value, the share market could be significantly higher. So we think that's the real risk now for investors.
That's Luke Laretive there from Seneca Financial Solutions. Don't forget, if you do enjoy the podcast, to give it a rating on Spotify or Apple Podcasts and to click that subscribe button.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.